Well, economic data out this morning suggests that the U.S. is firing on all cylinders, retail sales advancing in a very broad-based measure. No matter what you exclude or account for, it came in much better than expected. The control group, the best sales figures that we've seen in a couple of months. This had an immediate impact on the U.S. dollar, which spiked higher, and in the bond market, where we saw these yields move up by about 8 basis points now on the U.S. 10-year. Let's bring in Andrew Brenner, International Fixed Income Head at NatAlliance. Andy, thanks as always for being with us. So it seems like the U.S. economy very strong, at least according to the recent round of data that we've got. What do you make of it?
Well, Amber, once again, thanks for having me. Yes, retail sales came in much stronger than expected, which kind of put the rally in place as far as bonds, which had moved about 10 or 12 basis points down in yield over the last couple of days. And now we're reversing that. You know, the 10 years at a critical juncture right now at 408, 409. You know, we can see it getting all the way to 414. But we really do think that the Fed is going to continue to move at 25 basis point increments. We're looking at the world interest rate probabilities. We see 23 basis points for November, which is only in a few weeks, and another 25 towards the end of the year in December. So we still think the Fed's going to move 50 this year. But, you know, Amber, even though we're seeing good retail sales, and we also saw a very good Philadelphia Fed business outlook at 3 times the expectation, I still feel that the employment area is lagging. And I'm not quite a believer of last month's employment report. So we have one more employment report right before the Fed meeting and right before the election. We'll see how that turns out. But I do think the U.S. economy is slowing. But right now, the Fed believes kind of what I'm thinking, but they're going to move much more slowly. Meanwhile, I think the trade of the day is the steepener trade, because as I said, with the Fed moving lower in interest rates and the back end worried about what's going on with the economy, the strength, and now I think you're actually building in an election trade, which I think is spurring some of the weakness in the back end of the Treasury market. Okay,
let's take all of that kind of bit by bit. First, I want to push back on the notion that we should be getting another 50 basis points of easings. You're on the record, and you've told me many times you think the Fed is behind the curve, and we need to we need to get out of restrictive monetary policy. But the data, I guess whether you want to put much stock in it or not, suggests job growth is robust, retail sales are fine, inflation is still a bit of a problem. Is it worth the Fed pausing here to assess how that unfolds?
Absolutely not. No question about it. The Fed has to continue to move in 25 basis point increments until they see something dramatically change. The Fed is so far behind the curve. I mean, Amber, we have PCE somewhere in the low 2s, maybe mid 2s. You know, inflation, I mean, the Fed should be no worse than 100 to 150 basis points above that. So they should be somewhere between 3 3/4 and 4. And I think they'll get to 4 1/4 by the end of the year, and maybe 4% if we have a couple of bad employment numbers or fallout from the election somehow. But I do think the Fed is still well behind the curve, and it's going to continue to ease until we get to about 3.5. And that will be sometime between now and the middle of next year.
Let's talk about what you were alluding to in terms of the election getting priced into the bond market. Is that a Trump outcome? Because we see that elsewhere in other parts of the market, whether it's looking at Trump media stock, whether it's looking at betting markets, or even, you know, on the flip side, looking at the green energy sector, which has been under pressure.
Amber, you know, I look on the Bloomberg. Bloomberg has a function where WSL, and they give you world election probabilities. And I was looking at it this morning, and they showed Trump with a couple of Polymarket and one of the others of somewhere in the vicinity of 15 to 20 point lead. Now, I'm not promoting one candidate over another. I've already voted, so, you know, it doesn't really matter from my perspective. But I do believe that neither candidate is going to attack the deficit, at least not initially. But there's no question that the Fed will move in the direction that they think is right, which is lowering rates, which is going to affect the short end, which is why the short end while not doing that well today, is still outperforming the back end. I think the back end is more concerned about what the next president is going to do as far as deficit spending. And again, neither one is really put out any program to cut the deficit. I would give you my opinion here, but then I would be promoting one candidate over another. I'm not going to do that. I'm here to talk about the bond market, and I think some of that is being built in.
Okay, so you like the shorter end of the curve, like around the 2 years. What are you thinking in terms of, I mean, you're not getting much in terms of spreads. In fact, those spreads remain really tight. Is that sustainable?
When you're talking about spreads, you're not talking about corporate spreads. You're talking about spreads to Fed funds?
Corporate. No, I was talking to corporate.
Oh, corporate spreads. Yeah, no, I love corporates. No question about it. I love the short end of corporates because corporates are very well managed. They raised a lot of money. They issued a lot of debt when interest rates are much lower. They're in extremely good shape. And when I look at, and I didn't look at it today, but when I look at the CDS of the U.S. government, it's gotten awful. I mean, it's probably above everything in Europe except Italy and Greece. I mean, so I would say that if you have a chance to buy U.S. corporates, you should be doing it in the short end. And one other thing, Torsten Slok of Apollo put out a report today, very interesting, that overseas investors are at the lowest percentage of corporate ownership of U.S. fixed income, going down from a 15% average over the last 15 years to somewhere around 8%. So I think foreign corporations should be looking more at U.S. corporate assets. So no, I think the all-in yield of corporates make all the sense in the world. You are going to 3.5 Fed funds, and you'll probably be down at 3% at one point next year. So to be able to get something in short corporates somewhere between 5% and as Rick Rieder likes to say, maybe even 6%, I think makes all the sense in the world. And just book that carry.
Last, before I let you go, speaking of carry, what do you think of the U.S. dollar? Is it going to rip higher? Is it overdone? How much more momentum do you think there is?
I think there's significant momentum in the U.S. dollar, and it's not because the U.S. economy is strong, which today's numbers point out. I think it shows how weak the European economy is and how bad the Chinese economy is right now. I used to say on TV before, that we're the least dirty shirt in the laundry, and I'm going to use that one again. So I think the U.S. dollar's got a lot more room to go, maybe versus the euro somewhere in the vicinity of 105, 106.
All right. Thank you so much for that, Andy. We appreciate your insight as always. That's Andrew Brenner joining us from NatAlliance. We're going to take